Okay, on to Chapter 3, where we're going to talk about adjusting entries. So this comes at the end of the accounting cycle. So we've been chugging along all year, recording all our transactions, doing all our journal entries. And now at the end of the year, we need to clean some stuff up before we close out the year and generate our financial statements. And one of these things is adjusting entries, which we're doing in this chapter. So if we used cash-based accounting, so first of all, this can only be used by very small businesses that are small enough that they don't have to adhere to GAAP. So cash basis is not GAAP. Accrual basis means that we record the revenue when it is earned, not when the cash takes place, and we record the expense when it is incurred, regardless of when the cash takes place. Because you probably saw in Chapter 2, there's some things we pay for in advance, there's some things we pay for later, and it goes back and forth. And so GAAP requires us to use the matching principle, which says that I match the revenues to the expenses that were required to incur that revenue. So if I get a bill now, and so I received the bill today on September 19th, and it's not due until October 15th, let's say. That bill was for stuff that happened in September, and so I need to record that in September. If I waited and just recorded it when I paid it in October, then that would look like an October expense, and I would be recording October's expenses I would be recording September's expenses with October's revenues, and it would be all mixed up. And so when I report my revenue, some of it was from before, some of it's now, some of it's later, and the same thing with the expenses. So I can't really tell what's going on. I can't really tell how well I'm performing, what my profit is. And so I need to match these up. And so when I report an income statement, I need the revenues that took place this period with the expenses that went with those revenues that were required to generate those. That's what we mean by the matching principle. So if we used cash basis, we wouldn't have to do any adjusting entries. But because of that, I have a couple things that I have to do. So let's just look at a couple examples here of cash versus accrual, so you can kind of see what I mean here. I'm going to change this problem just a little bit, and I'm going to pretend like this is just for 1 month, okay? This is one of the demo problems. So I prepaid advertising for 4 months, so I paid in advance for $800. If, here, I'll just make it January. If I'm using a cash basis, then on January 1, I would just record that $800 expense. If I'm using accrual base, though, so really, that $800 was for 4 months, right? So if I took that $800, and that's over 4 months, that's really the expense is $200 a month for 4 months. And so if I was doing this with a cash basis, it would look like my expense in January is $800, and then February, March, and April, I would have zero expense. So the total is still $800. But that's not right? It would make January look really unprofitable, and it would make February through April look more profitable than they really are. Because just because I paid for it in advance, I'm really using it the whole time. So this is what I want in accrual. This is my goal of accrual, is to spread that out. And so if I said, how much advertising expense would it be for the month ended January 31, doing accrual based, that would be $200. But if it was cash based, that would be $800. And you can see the difference that might make in a net income. And so regardless of when I pay for it, whether I pay for it later or whether I pay for it ahead of time, I need the actual activity to be recorded in the month it happens. Here's one with revenue. This firm provides house sitting for people who are away. Some customers pay as soon as the job is finished, and some say just send me a bill. So at the end of the year, they've collected $1,000 cash from paying customers, and the remaining customers owe the business. So this would be in my accounts receivable, right? If I'm doing the cash basis, the revenue from the year would just be the $1,000 cash. But if I'm doing accrual, I'm going to include everything that happened this year. So the $1,000 I've already been paid for, plus the $1,400 that I did that I haven't been paid for yet, so I get $2,400. That's a pretty big difference in the revenue. That's more than double a difference in the revenue that I'm reporting for the year. That's one of the other reasons GAAP requires you to do this, because you could mess around with the time to lower your profit, right? If this one would have a lower profit, and so you'd be paying less taxes. So that's why that's one of the reasons GAAP requires us to match these up like this. South Shore Magazine sells subscriptions $60 for 12 issues. They collect the money in advance. So in this one, we're paid in advance for this one. The revenue recognition principle says, when do we record it? We record it when it's earned, not when the cash takes place. Not when the cash, when it changes hands, or not when cash is collected. So for this one, if it was $60 for 12 issues, then I have $50 or $5 per issue, right? And so it says, let's say somebody paid for a subscription in April, and so they paid me for 12 issues, but now it's December 31st, and I've sent 8 of those issues. So the revenue I'm going to record for 8 issues times $5 each is $40 of revenue. So that says they paid me for 60. I have now provided 40 of that, so $20 is what I still owe them. Either $20 worth of magazines or $20 back, like let's say they canceled it or something like that. So this is why we do adjusting entries, because we've got a couple things. One, we need to record the revenue, the $40 revenue that took place. But the other thing is, if I was paid in advance, this would have gone into like that unearned revenue account, that liability. And so the liability would be showing, and if I don't make any adjustments, the liability is going to be showing $60. But I don't owe that anymore because I've provided that. So I need to bring that down to show what I really owe. That's really what the adjusting entry is doing. It's recording the revenue or expense that needs to be recorded, and then it's going to update the asset or the liability to show a more accurate number. So here's one more. This is a rent one. So January 1st, Antonio's Tavern prepays rent of $6,000 for the year. So $6,000 divided by 12 months in a year means that their rent is $500 a month, right? So at June 30th, how much rent expense should be recorded for the period January 1st through June 30th? So $500 a month times 6 months. So I'm recording $3,000 rent expense. When I paid that, right, it went to the asset prepaid rent. So I started with $6,000 in prepaid rent as an asset. I've now used $3,000 of it as my expense, and so I have $3,000 left sitting there that they owe me, right? So that's the other thing. I need to adjust this prepaid rent asset, because if I were to move now, they're not going to give me $6,000 back, right? Because I've used half of that. I've been there for half a year. So this asset right now is showing $6,000, and that's not true. That's not what they would give me if I left right now. So I need to update that to the new asset balance, showing what they still owe me, which is $3,000. So that's really what I'm doing here in these adjusting entries. So let me just kind of give you a rundown here of adjusting entries. We really have 2 types. So what I'm doing here is, for one thing, I'm recording transactions that had no source document to initiate it. So we said in Chapter 2, there's something like a sales invoice or a purchase order, or something generates the transaction to happen. So we don't have that, so we need to record these things that took place but don't have any kind of source document. And the other thing, as we were just showing with the prepaid rent, I need to update the balance in certain assets, like prepaid assets, and certain liabilities, like those unearned liabilities, and a couple other things, as we'll see. So all of our adjusting entries fall into one of four categories. The first one is a deferred expense. So I'm going to use two words here. I'm going to use deferred, which means that the money changes hand first, and then the activity comes later. This will make a little more sense in a minute. The other type of thing we're going to see are accruals, and this is when the activity comes first, and then the money happens later. So a deferred expense means that the money took place first, and then the expense is actually incurred later. So a deferred expense would be like a prepaid expense, so like that prepaid rent we saw. And to make the adjustment to record the expense that happened and to update the balance, the account that I'm debit will always be an expense, and the account that I credit will always be an asset, like rent expense and prepaid rent or something like that. Or supplies is another one that we see. So anything with prepaid in the name, I need to debit some sort of expense to show what took place, and I need to credit an asset to bring that down to show how much I still have in that asset. I'm going to put 1A here, right? Because this is really a type of deferred expense, but it's different on its own. And that is depreciation. So when I buy, let's say, a long-term piece of equipment, like a computer or something that I'm going to be using for years, when I purchase it, I really don't want that to count as an expense just in that year. Let's say I buy a computer that I'm going to be using for 2 years. If I put that entire expense in January of this year, because let's say this is a big expenditure, that's going to make January look really, really unprofitable, and then I don't have any expense at all for the rest of the 2 years, the next 23 months. That's not really accurate either, right? Because that computer is going to be helping me generate my revenues for the next 24 months. So I need to spread that across. And so that's what I do with depreciation. So I'm going to debit an expense, and it'll be called depreciation expense. But instead of crediting the asset, I'm going to credit what's called a contra asset, which is the opposite of an asset. And once you've identified it as depreciation, the journal entry actually is pretty simple, because you are always going to debit something called depreciation expense, and the contra asset is called accumulated depreciation. And that journal entry will always be the same. So I have some examples of these later. I'm going to kind of show you all four types, and then we'll look at examples of them, okay? So the second type is a deferred revenue. I keep spelling that wrong. Deferred revenue. And this is when you're going to see like the unearned revenue. So again, the money took place first, and then the revenue takes place later, and the revenue later. So in these, I'm always going to debit a liability, which will almost always be unearned revenue, and I'm going to credit the revenue that actually took place. Revenue. The fourth type we see is accrued expense. So these are expenses, again, where the activity takes place first and then the money comes later. So for these, I'm always going to debit an expense because the expense has happened, but I haven't paid it yet. I owe it, so I'm going to credit a liability. The common examples you see in this one, and these guys kind of always go together. So you'll see like salary expense and salary payable, or tax expense and taxes payable. They kind of go together like this, but you're always going to be debiting an expense and crediting a liability. Because the expense was incurred now, but I haven't paid it yet. The money will come later, and so that's why I have to credit a liability. And then the last one we see here is accrued revenue. So I have deferred expense, deferred revenue, accrued expense, accrued revenue. And so for this one, again, the activity takes place first. I do the activity now, but I haven't even billed them yet. And so they owe me the money, but it's not like it's late because I haven't even billed them yet. So in this case, I am always going to debit an asset and credit the revenue. Again, the revenue is what's happening, so I need to record that. And the asset is always going to be accounts receivable. So to abbreviate that, AR, that's accounts receivable. All right, so that is all the adjusting entries have to fall in one of these categories. So this is something to, this is a little cheat sheet here for you. Keep this handy. You can say it in whatever words make more sense to you. But once you've identified which one of these 4 types of adjustments it is, here's your cheat sheet. All right. Well, depreciation, for example, it's always the same. But if I know this is an accrued expense, I know I need to debit an expense and I need to credit a liability. And after a while, you start seeing the same types of transactions over and over again, the same things that need adjustments. And again, adjustments are not fixing errors. Adjusting are recording things that actually did take place, but there was no source document to generate the transaction. So these are expenses or revenues that really did happen. So the expense happened here, and I'll pay it later, or I've already paid for it, so there's no thing in there. Or the revenue really happened here, but I was already paid, or I'll get paid later. And so the revenue or the expense really did happen, and I need to update that and record that before I close out the year. So I'm going to stop this one here and post it. And then in my next video, we're going to walk through a bunch of examples of these that are all in the demo problems for you. And I promise once you start doing them on your own, they really do get a little bit easier. But I'm going to walk through a bunch of examples of each of these, these 4 types. Look, I can't. That's really comforting from an accounting instructor, isn't it, that I can't even do numbers. There we go, 1, 2, 3, 4. So we'll walk through these 4 types, examples of each of these in part 2 of this video.